Welcome back. Glad to have you. We are about the middle of page 20, talking about mutual funds, and all of these topics, especially in through here, is very, very fertile territory to grow some questions. So you might need to go back and review this module in particular a little bit more, just to make sure that you have a real good understanding. And always, always take as many practice exams as you can. Okay, I mean, there's no substitute for that. Just as many practice exams. If you don't have a good test question bank, it's worth the money to get it. Okay, several real reputable providers out there. So anyway, but like I say, do as many test questions as you can, and then look at why you miss what you miss. That's going to be a very important step in getting those incremental questions right. Because especially if you're missing words like accept, words like not, things like that, just be very careful about that, because it's a good way to pick up those incremental answers. Okay, so let's pick up, like I say, middle of page 20 with dollar cost averaging. Dollar cost averaging. Now, dollar cost averaging is a systematic investment of a fixed dollar amount at regular intervals. So typically a month. Okay, that's what typically you'll do. There's going to be a form in the back of a prospectus where your customer can sign it, attach a canceled check, and bing, just once a month they'll ding that checking account. Okay, that's dollar cost averaging. That's what they're doing. All right. The result of dollar cost averaging is a lower average cost per share than the average price per share, and that's double talk. Okay, so let's make it make sense. If I do that, then my break-even point is going to be lower than the average of the prices that I paid if I take each of those prices and average them out. And it's not magic, it's just math, okay? You're buying more shares when it's low, fewer shares when it's high. Therefore, your individual break-even is going to be lower than the average. If that's the case, then, and you're very likely, if you do have a math question, this is likely to be a math question, all right? Where you basically, your customer puts in $1,000, okay, over a 5-month period. And the prices that were observed on the day that the customer buys it were 20, 24, 22, 20, and 20, I gotta get this straight, there we go, 24, okay? Do the easy thing first. What you want to do is you want to say, okay, there's for a 0, and there's 2, 4, 6, 8, 10, 11. There we go. Divided by 5 purchases. My average cost is $22. Is there only one answer that's less than $22? There is? Pick it. Do not do any other math than that. Okay? Typically, there's only going to be one answer lower than $22 in this case. All right? Pick it, smile, go on down the road. Okay? Because there went that complicated math. You know what I did? I didn't do that. I did all the math. I did all this, all that, all something else. And I looked at it. Well, no. There's only one possible right answer. Man, I tell you what. If you have 2 of them that are less than that, then how many did you buy here? You bought 50 shares. I'm not going to do all the math here, but how many shares we bought there? Okay. And basically you wind up with your average price per share is here, but your average cost is $5,000 divided by whatever this totals up to be on the 5 purchases. Okay. And just figure it out. Okay. So that's your average cost per share. But it's going to be less than 22, I'll tell you that much. So do the easy thing first. All right. Now, that's good, and it's a great way to, nothing beats systematic investment, really. Especially like for a young person, in an UGMA account, something like that. Man, I tell you what, if it wasn't for those systematic investments, we'd still be paying some tuition bills and student loan bills for my daughter. But, fortunately, UGMA account where my dad contributed some stuff, and then I came in every month, did like so. Next thing you know, she's going to college. Next thing you know, we're paying all the bills. Boom, done deal. Okay? So anyway, it's a great thing to do. The thing about it is, Look at the next bullet point though. It does not guarantee a profit. If your price over the course of the time that you're investing is doing this, then what you're doing, you're just averaging down and down and down. At some point it's got to do this before you make a profit. It lowers your break-even point, but it doesn't assure a profit for you. And typically, like I said, it's the goal of accumulation programs and concurrent investment and withdrawal programs should be avoided. All right, we're getting ready to talk about those withdrawal plans, so let's just go ahead and look at them first, and then we'll circle back around and pick up that bullet point, all right? So basically, once we have stuff in there, hey, tuition came due, liquidate this much money, all right? But what about if I retire and I want a systematic investment, a check every month, every quarter, every however so often I want it? I can do that by setting up a withdrawal plan, and I can do so by getting a fixed dollar amount per month. That's okay. However many shares it takes, that's how many they're going to liquidate or redeem, and that's how much I'm going to get that fixed dollar amount. Or I might say, you know, redeem 20 shares a month for me, 30 shares a month, 50 shares a month. However much it generates, cool. I mean, if it goes up in price, then I've got a raise. If it goes down, well, you know, maybe we'll have to tighten the belt a little bit. But that's fine. Just go ahead and do it. I could take a fixed percentage of the portfolio. And so I'll be getting more as the portfolio goes up and less as it goes down over a fixed time period. And what we'll do, let's say that we have a 5-year period. The first month I'll get 1/60th. The next month 1/59th, 1/58th, 1/57th. You don't need all that detail for the exam, but that's basically how it works. And finally, in month number 60, you're getting 1/1 or all of it. So that's the way that a fixed time period works. And then withdrawal programs may deplete the investor's principal. That's something that you need to be aware of to tell your customer, well, yeah, we can do this, but you know that you might eat into your principal. You may or may not be able to get the earnings, get the capital gains, get the growth of price, okay, that would allow you to just take off earnings. You can take earnings only if you want, but if we set up a systematic withdrawal program, you might eat into your principal. Now, here's the deal, okay? We've got this money that's in our fund, all right? And the way we got that much money was that we set up a systematic investment program where we take dollars every month and put them in. The thing about it is that right here, we see a sales charge. What we can do then is what the question is going to ask if we want to do is that if we want to then take this and set up a withdrawal plan. But the thing about it is that if we do this, it's going to come out at NAV. Now, wait a minute. Why would we sacrifice that sales charge? The better thing to do, okay, the better thing to do is just to take this, here we are over here, okay, take this money and divert it. There we go. Keep it. And then if this is $500 and we need $700, reduce this amount down to $200. You're not incurring any sales charges. You're disrupting this to the minimum. It's much more efficient for your customer. Okay? So like I say, concurrent accumulation and withdrawal plans are discouraged. That's really polite for when your principal and compliance officer find out what you're doing, they're going to call you into the office. Okay? So anyway, just like I say, don't want to do that. Shareholders own an undivided interest in the fund's portfolio. Now, it's a fancy way of saying that if I own this much, I'm just going to leverage off of this drawing, okay? There we go. That I have, that money is 100% diversified because I own every stock, every bond, every whatever it is that the fund owns. If I sell a portion of it, I am still 100% diversified. Whereas if I owned these individual stocks, there we go, I've got 5 of them, and I need some money, so I sell this one. Now I only have 80% of the diversification I had before. With a mutual fund, I go from 100% diversification to 100% diversification, even though I took money out. The smallest purchase, 100% diversified. The largest holding, 100% diversified. All right, so that's an undivided interest in that portfolio and what it means to the investor. Shareholders have voting rights, so the elections are decided by a majority of the shares that vote, as opposed to the majority of the shareholders, because each share has one vote. All right, and this is true whether you're talking about a corporation or a mutual fund. It's a majority of the shares that win the election. Vote on the board of directors. Vote on the investment advisor, which is the fund manager. Talked about them. The approval of the custodian and the registrar, just like a registrar with a stock. Okay, approval of the transfer agent as well. And then any changes in the investment objectives of the fund. I had one fund that the tax laws changed. Legislative risk, right? Yeah, the tax laws changed. And not only would it not work, it would be punitive to the shareholders if they continued to do what it was that they were doing. Okay, so man, I tell you what, that fund family, the sponsor, they really were scrambling to make sure that they had enough votes that said we're in favor of this, that we, the reps, called up and explained what was going on so that they could get the favorable vote, because they just couldn't punish their shareholders because the laws had changed, tax laws had changed. All right, so let's see, then we also, changing the load structure. Changing in the structure of the fund. We can go from a closed end to an open end to a closed end. We can go to an open end to a unit investment trust. We can okay? But it's going to take a shareholder vote to do so. So what we might want to do is that, now, one thing that the fund can do, they can actually close off a fund to new investors because it's become too big and unwieldy. That does not change the structure of the fund. It just means that if you're not here already, then you can't put more money in. All right, that's all it is. It's still an open-end fund, okay, but it's closed to new investors. They can choose to do that, again, if the fund gets very large. And then approval of the decision to incur bank debt that we talked about. We talked about the 50% subject to the 300% asset coverage. But shareholders do not vote. They do not vote on distribution policies, because if they did, remember, all those distributions are taxable to the shareholders on a current basis. How would you vote? You'd vote to not get anything and not have any tax. What would that do? That would blow you up. Because remember subchapter M? Subchapter M says that if I as the fund don't distribute out at least 90%, then I get taxed on it all. You'd have double tax. That's no good. So like I say, you don't even have that possibility of voting on distribution policies. That's the business of the board. The day-to-day investment decisions. That's the business of the asset manager. And so one of the questions that you're likely to see is that XYZ fund wants to go from a 0% cash position to a 15% cash position. Does it need a shareholder vote? No, because that's why we hire the investment manager, is to make those types of decisions. In fact, I have seen a fund that it's in the prospectus. They can do this, and they can do it on a dime. No pun intended, okay? They can go immediately, if their trading models say so, they can go immediately from fully invested to all cash. That's why you hire the investment advisor. All right, so anyway, as long as they're staying within the parameters that are listed in the prospectus, no. Let's see, then the board of directors, a majority of the directors must be non-interested. In other words, not employed by this SPUD. Okay? Now, just because you are employed by Franklin Templeton, okay, and you're in the industry, that doesn't mean that you're an insider to Putnam funds. And again, just using a couple of big funds, just because they come to mind, not endorsing or making any bad comments, just a couple of them that come to mind. But like I say, if you're an officer or director of some other management company, you're an outsider to this fund. But if you're under our umbrella, then you're an insider. Majority of that board has to be outsiders. And then management contracts are approved initially by the board and the shareholders if you prefer to call it that, but it's actually shares, for a 2-year contract. Renewals then are by the board or the shares with a 1-year contract. And one thing about this is kind of funny because I love it, it's that a management contract can be terminated with a maximum 60-day notice. Now you'd think it'd be minimum, but it's not, it's maximum. And I realized what the deal is that if the shareholders basically give a vote of no confidence, then the sponsor of the fund has to kick that guy out and can't wait for more than 2 months to find a replacement. So it's a maximum of 2 months, 60 days. All right, so let's go ahead and look at the 12B1 fees real quick, and then we'll circle back around, and I want to show you a little reminder tool, okay? 12B1 fees, these are those distribution fees, not loads, okay, but it's what the SPUD will use to help encourage new people to buy, to invest in it. They're approved initially by the board and the shares, reviewed quarterly, but renewed annually by the board or the shares, and it can be discontinued by a vote of the shares or a vote of the majority of the board. And what is the majority of the board? Outsiders. Okay? So, let's go ahead and look at 2 things here first, okay? First of all, we have a review and a renewal. If I misspell review, oops, and then I spelled it right. This is hard to do, actually, to do this purpose misspelling. There we go. Now, how often do you review Roman numeral 4? 4 times a year?
Quarterly.
Yep, so quarterly. If I renew, how often does that happen?
Annually.
There we go. Okay. And that's on the 12B1 fees. Now, this is what I call the new math, okay? 1 equals 2, 2 equals 1. There's the new math for us, okay? What are you talking about, Dan? Here we go. Let's talk about management fee or management contracts. And let's talk about 12B1 fees. Okay. We have the initial, in other words, the number 1 time that we put that into place. And we have the renewal, in other words, the number 2 time that we put that into place. What we've got, check the new math. 1 equals 2, so the initial on the management contract is that it takes 2 parties and it's for a 2-year period of time. But the number 2 time that we do it, it just takes 1 party, either the board or the shares, and it's for a 1-year term. Over here on the 12B1 fees, 2 parties, board and the shares, but on the renewal, just 1 party, board or shares. So 1 equals 2, and 2 equals 1. Okay? On both the management fee and the 12B1 fees. Okay, let's see, we are getting pretty close to the end of this section, so let's go ahead and plug on through on this section, and then we'll just wrap that up. It might take us a little bit over a 20-minute video, but it'll be a natural breaking point for us. So let's compare mutual funds, one to the other. What have we got? We have to make valid comparisons. Common objectives, okay? If we compare a bond fund to an aggressive growth stock fund and the market has been good, guess which one is going to blow the doors off the other? Yeah, the aggressive stock fund is, but is that an appropriate comparison? No, no. Okay, we want to compare stock funds with stock funds, bond funds with bond funds, and over a common time period. Because you can have periods that the markets are strong, whatever market you're in, or markets are weak. If you compare the one in a weak period and the one in a strong period, can't do that. That doesn't work. So make sure you've got apples and apples. You have statistical or numerical factors. So you got performance using net to investor figures. Always use the bottom line to investors, net of all expenses and fees. And so use that. In fact, that's what the funds themselves have to provide, is net figures. And then also total return, which would include not only the dividend income, but also capital gains. Now, let me ask kind of a rhetorical question here. Can you count on capital gains? No, I wish you could. That would mean that we would have a strong market and you'd pick well every year. You cannot count on that. Dividends are a little bit more predictable. So if you want to look at and by the way, a dividend is a return on your money. A capital gain is a gain of your money. Okay, so like I said, if you want to look at income, just look at the dividend income that these things produce. All right, so anyway, you've got the total return given common reinvestment choices, because if I'm reinvesting everything, my money's going to build up more than if I'm taking everything out in cash. A standardized yield, which again, very likely to see a question on this. If you want to see how much something yields, a mutual fund, do not include those capital gains. Capital gains are totally different. Okay, just look at the dividend income from it. And the thing is, I keep referring to it as dividend income. You might be saying, but what if it's a bond fund? Doesn't it pay interest? No, because common stock, which is the only thing that the mutual fund company can issue out to shareholders, always pays, when it pays, it always pays a dividend. Now, because of that conduit treatment, better to talk about municipal bond funds, okay? Because of that conduit treatment, since the money comes into the fund as tax-free income, and it goes into the pipe as tax-free income, it goes out of the pipe on the other side, but it would be a tax-free, but it's still a dividend. Okay, so it's just one of the little things that to keep in mind. All right, in fact, even when a fund pays capital gains, it will be this much dividend, of which that much is capital gain. Because that's the only thing that a stock can pay is dividends, and that's the only thing that a company can issue, a mutual fund can issue is common stock. So, management fee, all factors being equal, a lower management fee is better because that eats less into your investors' pockets. All right, but if you've got a 20 to 30 year treasury bond fund and you're comparing it to a Botswana emerging growth fund, it's going to take a heck of a lot more money to research stuff in Botswana than it is to buy treasuries that are 20 to 30 years in maturity. So, like I said, compare apples to apples. Be sure that you have that, that good, strong comparison. But the management fee, all other factors constant. The lower one's better. Sales charge, again, all other factors constant. The lower the better. But if you have performance that does better, sometimes it's worth it to pay that. And expense ratios, again, all factors constant. The lower the better. But you have to make sure that all your factors are constant. And then comparing non-statistical factors, which are benefits. So the numerical factors you can quantify. The non-statistical factors, it's just nice things to have. I was talking to a guy one time that said, I'm finally reaching the point where I got some money in my checking account. I'm paying my rent. It's okay. I just got a raise, and I'd really like to start socking some of that money away. I don't really have anything other than just the incremental money from my raise. I said, look, what you want to do is to check and find a mutual fund that has an automatic investment program that you can just set up the automatic ding to your checking account, okay? consistent with your goals. And a lot of times they'll have a minimum like so, but if you take out a check every month, they'll take that minimum and drop it way the heck on down there. Says, oh yeah, so I might be able to afford, yeah, just, that's going to be a real benefit to him. Otherwise, he's going to put it where he's tempted to spend it. He knows what he needs to do, but doing it sometimes is a different story. Exchange features. Most funds, and for this test, if you're within the family of funds, you can go from Fund A to Fund B. It'll be a taxable event, but you'll pay no sales charge. Okay? So if they check it out to make sure that you can go from wherever you are to the target fund. Okay? Because some funds, again, if you're comparing two families of funds, this one is just absolutely no charge. This one charges you some kind of a redemption fee, let's say. Wait a minute. If I do much switching over time, that's going to add up. And then distribution plans, just to make sure that when the time comes to take money out, that you can take it out the way you want. And all that information that you use to compare is going to be in your prospectus or the statement of additional information. Okay, statement of additional information just goes into a lot of detail, and it's available to shareholders on request. Typically you don't send it out, but if somebody requests it, just send it to them, and that's going to have just a whole lot of gory detail. Now, for you should probably look at the statement of additional information, because there is good information that you'll use that's in the SAI as opposed to the prospectus itself. You need to be aware of that, so you need to look it over. Okay? A lot of customers, they couldn't care less about what's in there. But if they do request it, got to send it, of course free of charge, not marked up, because it kind of is part of the prospectus. So anyway, that wraps us up. When we come back, we'll be talking about variable annuities. So we'll see you on the next module.